Good evening, everyone. Time for another silver update. Now, before I show you what this chart is, I just want you to look at the beta of this chart. In other words, how tightly correlated these areas are. You can see this area now. In fact, this downdraft here, which was, you can see the financial crisis, that they're so tightly correlated that you can't even see the difference. And this is the second most, this current uptrend that we're on with just the recent breakdown. So what this is the German DAX, and that's the key German stock market index, overlaid over the Dow 30 industrial average. Now, why am I showing this chart? Well, I'm trying to demonstrate a point here, and I'm going to show in subsequent information here that the markets are all correlated with each other so closely that there's really no difference between them. The reason for that is that markets now are driven by money. Now, in the past, for example, the DAX is an example. If you go and read, and I highly encourage you to read the first Market Wizards by Jack Schwager. It was published around 1988, I believe, and it is an interview. It has Jimmy Rogers, Ed Seykota, Paul Tudor Jones, and in that book you have an interview with Jimmy Rogers where he talks about his decision to invest in the DAX, or actually just in Germany in general, after there had been a very long lull in the stocks there. And he describes other investments that he made, and of course very successful because he's one of the greatest investors in the world. And the German DAX was very, it wasn't correlated with any other markets. And that was the case for many, many years, many, many decades. In fact, you could have roaring bull markets in certain countries, and that makes sense because the stock market is supposed to reflect the rapid increase in industrialization or the wealth of a nation, just as a currency represents that. We're no longer living in that sort of world. The world that we're living in now is a world of central bankers where everything is a reflection of how much money is being printed. That's why you have this tight correlation between the Dow and the DAX. And by the way, I think this is implying there's going to be a dramatic drop in the Dow. We look at this drop in the DAX, and if we zoom in here very closely to the period of the financial crisis, and that's right here, then it basically was in lockstep crash. I think that's, again, what we're going to see, and the reason why we're going to see that is because everything is going to go up at once. Now, one of the reasons that that is the case, let's look at this article from Zero Hedge. This is posted today, and this is about Portugal's Banco Espírito Santo. And this is one of the latest banks to go under. And this is nothing new. We know that most of the banks are already insolvent. In fact, as I'm going to show you, the countries themselves are already insolvent. But the central bankers of the world have, the best way I can describe it is if you remember when you'd see a performer on stage who was a plate spinner, and the master plate spinner was somebody who could spin, say, 30 or 40 or 50 plates on these poles and keep them going all at the same time, and then you have to constantly run from one part of the stage to the other to get this plate spinning faster to keep it from wobbling and falling, and that was a big performance thing that people did. That's exactly what the central bankers have to do with these banks and these countries, in fact, is that they have to rush from here to there, constantly trying to prop up these things that are going to fail. And of course, the entire system is going to fail, and when it fails, it's all going to fail at the same time. So let's read a little bit about this bank, and then I'm going to show you this chart of their bonds. The details from Bloomberg about the transaction that will wipe out the existing equity and replace it with 100% ownership in the Resolution Fund. Portugal may use the Resolution Fund to recapitalize Banco Espírito Santo. Diario Económico reports, citing unidentified people linked to the process. A resolution fund may inject more than 3 billion euros. A bad bank may be created for the toxic assets of the credit portfolio. Solution aims to rescue Banco Espírito Santo without spending taxpayers' money. And of course, this is going to be the big theme going forward, because what they got away with last time was looting the taxpayer coffers to bail out these banks. What they're going to do now is they're going to loot the taxpayers' retirement and savings. And that's something that you have to keep in mind. A lot of people ask, when is silver going to go up? When is gold going to go up? Well, frankly, it doesn't really matter whether it goes up at all. The reason you buy physical silver, the reason you buy physical gold, is because when this system collapses, and I believe, looking at these charts, that it is all going to collapse at the same time. Back to the plate spinning here. We've got the banks of the world rushing over to this one plate that's wobbling and get it spinning again. But there's going to come a time at the end of the show when all the plates that are spinning on all these poles are going to all fall to the ground at the same time and break. Now, I wanted to show you this chart of the bonds of this Banco Espírito Santo. You can see here that we know with bonds that 100 is par, so I'm not really sure how these are calculated, if these are euros or what these are. But you can see that for a period of time here, that the bonds traded at par right here, around 100. And then we had this huge kind of bull rush into this bank's bonds that actually drove it to 110 beyond par. And so what that means is that people were chasing yield. Now, I don't know what the yield was on these bonds, but probably as long as the system was going, as long as all the plates were still spinning, people figured, all right, well, let's go after the highest interest rate that's out there. And that's exactly what they did. That's what drove up the price of these bonds. But you can see, once the news started to leak out, then the dramatic selling began. You had a little bit of a recovery, and then a huge smash, another recovery, and then a complete collapse. And you can see we're down to 39. So anybody holding these bonds has pretty much taken a 66% haircut, and I don't think this process is anywhere near over. So what this demonstrates is that all of these facts are there the entire time, but it's only when the realization occurs that you get the dramatic moves. And of course, I don't know what the ratings were on these bonds. The ratings could have been AAA, and then they're probably wait now and downgrade them. But, you know, there is no early warning to these things. The entire system is a bunch of spinning plates, and they're able to keep it going, but at some point, when it collapses, it's going to be catastrophic. And the only people who are going to come out of it on the other end are the people who have real assets. Now let's go over to the national debt clock. Now this is something that I come to frequently, and this is not the most accurate. It's adjusted on a lot of things, so you can't really go by this. You have to go debt to the penny, but you can see we're looking at about 17.6 trillion on the national debt. We're looking at federal spending, and you want to look at the direction of these. You can see federal spending is rising, but the federal deficit is dropping. Of course, we're running a $570 billion budget deficit, okay? This is during a reportedly good time. This is supposedly the 5th year of an economic recovery, which under normal circumstances is actually a time for another recession. So this is a lull or a calm before the storm, and we're running $570 billion budget deficit every year. And again, that's just what's reported. I don't think it's anywhere near that number. I think the true number is closer to $1 trillion, but we're not going to find anything out until the entire thing collapses. But I wanted to point out to you some of these other numbers here. These aren't the numbers that concern me. It's these numbers over here on the right side that are very concerning. Now, I want to point out that they didn't used to have these numbers on the national debt clock, and I think it's very enlightening looking at these new numbers here. That we now have U.S. Workforce 2014 and we have U.S. Workforce 2000. And we have Not in Labor Force 2014 and we have Not in Labor Force 2000. Now, if you add these numbers up together, they're fairly closely matched, but you can see that the workforce in 2000 is about 6,000 less, or 2014 is about 6,000 less than it was 14 years ago, while the not in labor force is about 14,000 higher than it was in 2000. Now, that's bad news, but I want to show you the really, really bad news, and that's this when you add up all of the numbers here. Now, we have a total of 118 million full-time workers. Now, we can see here that we have state and local employees at almost 20 million, and we've got federal employees at 4.3 million. So we're talking about 24 million workers that we need to take off of this number, because you have to remember these workers are not contributing anything to the national economy. They're simply takers. They're the same thing as these receiving benefits. So we're going to subtract these 24 million from here, and that's going to leave us about, say, 94 million total workers. And then we go down here and see this number. Here's the total number receiving benefits. We've got 156 million Americans who are receiving benefits from the government. If we add in the 24 million workers who work for the government, we're talking about 180 million people who are dependent upon roughly 94 was the number I used, or 92, 94 million people. That's already 2 to 1. In other words, for every worker in the private sector, there are 2 government beneficiaries or employees dependent on them. So there is no question that this system is going to collapse. It is going the other direction rapidly. We haven't even gone into an economic downturn, and you can see from the chart, it's very clear that that downturn is coming, and it's coming very quickly. So when that downturn comes, the amount of spending is going to explode, the amount of people laid off is going to explode, and we're going to have that number of workers shrink. We're going to have the number of beneficiaries rise, and then that's going to be an endgame scenario, because you can't have 3 people living off of every 1 worker. Well, we used to have that. It was called a family. But now we have government families, and we know the inefficiencies when government is involved in anything. So just like the Banco Espirito, just like the German DAX and the Dow, all of these things are going to come about at the same time. There's going to come a time when, although they're running around the stage trying to keep those plates spinning, there's going to come that moment when that first plate falls. And when that first plate falls, what happens is the magician, or whoever he is, he begins to panic, he loses his concentration, and he runs and is too late, and the next plate falls, and then eventually every one of those spinning plates on the stage comes crashing down at the same time. All the markets crash, and the only people who have anything when that occurs are people who have physical gold and silver. And we'll talk to you next time.